Understanding Long-Term Equity Anticipation Securities, LEAPS. Introduction. Long-Term Equity Anticipation Securities, LEAPS, are a specialized financial instrument that provide investors with unique opportunities for long-term investing through options trading. Launched by the Chicago Board Options Exchange, CBOE, in 1990, LEAPS are options contracts that expire in more than 1 year, allowing for a prolonged exposure to market trends. This article will explore the intricacies of LEAPS, their mechanics, premiums, advantages, disadvantages, and the different types available in the market. What are LEAPS? LEAPS function similarly to standard options but come with extended expiration dates that can span from 1 to 3 years. This longer time frame provides more flexibility for investors, potentially enhancing the profitability of their positions, especially if the market conditions or the price of the underlying asset moves favorably. A LEAPS contract, whether it's a call option or a put option, allows the buyer the right, but not the obligation, to purchase or sell the underlying asset at a predetermined price, known as the strike price, on or before the expiration date. Key takeaways. Expiration. LEAPS are options contracts with expiration dates longer than 1 year, typically up to 3 years. Ideal for trends, they are well suited for investors looking to capitalize on prolonged market trends. Hedging strategy. LEAPS serve as valuable tools in hedging strategies, making them useful for protecting retirement portfolios. Premium costs. The cost of LEAPS is generally higher than that of standard short-term options but is lower than purchasing the underlying shares directly. The mechanics of LEAPS. Like regular options, LEAPS require investors to pay a premium, which is the upfront cost of acquiring the option contract. This premium is influenced by several factors, including the time until expiration, the volatility of the underlying asset, the strike price, and current market conditions. For example, if an investor purchases a LEAPS call option on General Electric, GE, with a strike price of $25, they have the right to buy 100 shares at that price before the option expires. If at expiration the market price of GE is significantly above $25, the investor may decide to exercise the option. However, if the market price is below $25, they would allow the option to expire, losing only the premium paid. Investors should also be aware that, like all options, the value of LEAPS may fluctuate significantly due to market dynamics, including changes in interest rates and volatility. Types of LEAPS. LEAPS can be categorized primarily into 2 types. 1. Calls. LEAPS call options allow investors to benefit from potential price increases in specific stocks without needing to purchase the shares outright. This option is beneficial for those looking to leverage their capital while potentially limiting risk compared to direct stock purchases. 2. Puts. LEAPS put options serve as a hedge against declines in the price of stocks that an investor may own. If the price of the stock drops, the value of the put option rises, thus mitigating losses from unfavorable price movements. This can be particularly advantageous for long-term investors concerned about market volatility. LEAPS premiums. Premiums for LEAPS contracts are generally higher than those for standard short-term options, largely due to the extended duration until expiration. This provides more time for the underlying asset to experience favorable price movements. The premium comprises 2 main components. Intrinsic value. This reflects the actual profit potential of the option based on the current price of the underlying asset and the strike price. Time value. This component captures the additional value due to the time remaining until expiration, with longer durations typically resulting in higher premiums. For example, if the premium for a LEAPS call option on Facebook, Meta, is $6.25, the total cost to the investor would be $625, since each contract represents 100 shares. Advantages of LEAPS. Investors may find several advantages in using LEAPS, such as 1. Longer time frame. The extended duration allows for strategic planning and execution, enabling investors to withstand short-term market fluctuations. 2. Flexibility for hedging. Investors can use LEAPS to manage risk in their portfolios effectively. 3. Diverse options. A variety of LEAPS are available, covering individual stocks and indices, facilitating strategic positioning across different sectors. Disadvantages of LEAPS. While LEAPS can provide significant advantages, they also come with drawbacks. 1. Higher premiums. The cost of entering a LEAPS contract is greater than that of shorter-term options. 2. Capital lockup. Funds invested in LEAPS may not be easily accessible for other investment opportunities during the contract's duration. 3. Market sensitivity. The performance of LEAPS is heavily influenced by shifts in market conditions, which can lead to volatility in premium pricing. Example of LEAPS in action. Consider an investor who anticipates a market correction over the next 2 years and owns a portfolio primarily consisting of S&P 500 stocks. They might purchase LEAPS puts on the S&P 500 index with a strike price of $3,000, paying a premium of $300. If the index falls below $3,000 at expiry, the value of the put option will increase, helping to offset losses in the investor's portfolio. Conversely, if the index rises, the LEAPS put would expire worthless, resulting in a loss of the $300 premium. Are LEAPS a good investment? LEAPS can be an effective investment strategy, especially for individuals who have a medium to long-term perspective. They provide an avenue to capitalize on potential price movements without requiring significant capital to buy the underlying assets outright. However, investors should fully understand the risks, including the possibility of losing the entire premium if the option expires worthless. Conclusion. Long-term equity anticipation securities, LEAPS, offer a distinctive way for investors to engage in options trading with a long-term perspective. While they come with higher premiums and certain risks, their flexibility and potential for hedging make them a valuable tool in an investor's arsenal. By carefully evaluating market conditions and strategic objectives, investors can leverage LEAPS to enhance their portfolio performance.